Hi, Greg Weldon here with another episode of Money, Markets, and New Age Investing. And today, it's about Captain Crunch. And for those of you out there who might not know who Captain Crunch is, simply a character created to market a cereal. So Captain Crunch is one of the most delicious cereals out there. And of course, I ate Captain Crunch like mad when I was a kid. So certainly something that's been around with me my entire life. So it's interesting. But it applies here in the terms of the word crunch and in terms of the word credit crunch. And in that vein, we've said all along since we started this podcast over a year ago that a credit crunch would be the Fed's worst case scenario, that Paul Volcker was very specific in his language that we do not want to see a credit contraction. And Jerome Powell, a disciple of Paul Volcker, who's used the Volcker playbook here throughout his career now as the Fed chairman, that was the one difference. Both him and Janet Yellen had said, maybe we should see a little bit of a decline in credit. There's too much credit, especially in terms of the consumer. And it's watch what you ask for. You just might get it. And Captain Crunch is on the scene. We're going to start, and we got a lot to go through. And this is really good stuff, man. I got to tell you, when we talk about first the stock market, where it is, record highs, what is that record high built on? It's built on expectations the Fed's going to cut rates. It's built on the expectation that the economy is strong. Well, if the economy is strong, then the Fed's not necessarily in a rush to cut rates. So that's a bit of a conflict right there. But these are the points of optimism along with AI that have kind of created a couple of little bubblicious themes that are driving stocks to record highs. The breath stinks in the U.S. stock market. The Russell 2000 is nowhere near a record high. The divergence is stark, and it is a warning sign. We look at the consumer discretionary sector, which all of a sudden has picked up some steam in terms of the stock market and those equities. But relative to the staples, it's not breaking out. And that ratio is critical and has always been critical to the continuation and sustainability of any rally or decline in the S&P 500. We don't have that. What we have is the NASDAQ, the tech sector, AI, and a couple of bubblicious dynamics going on. We're going to talk more about that in a minute, but we have to work through these things. And we're going to start with the presumption that the economy is strong and the presumption that the labor market report that we just got at the first week of February here, it is currently February 10th when I'm recording this. So a week ago from yesterday, was really strong, 350,000 plus new jobs, non-farm payrolls. It was making headlines, right? Average hourly earnings skyrocket, and the year-over-year rate change vaults to 4.5% year-over-year, which is right where the Fed would love to see it against the 2% inflation, give you 2.5% real wage gains. This is a strong labor market. But, of course, then the question is, why would the Fed cut rates? Inflation's come down to 3-ish. So a 5.5% policy rate's restrictive enough for sure, maybe too restrictive if inflation gets a 2 handle. But that's likely not to happen anytime soon. It could happen this year, but the market's ahead of itself on that. So that's one little bubble. But in the context of the bubble that is the economy and the thought the economy is strong, let me show you where the economy really is. Because and when you talk about employment, all right, the number of jobs created, well, actually, in the household survey, jobs were down 31,000. Within the household survey, the labor force dropped 175,000. But the number not in the labor force dropped 275,000. Where'd those people go? I mean, this number seems massaged to me, and I don't make that claim lightly, and I don't usually talk about manipulation of the data. The data is what it is. You understand what it is. You can use it for what it is. But when you look at other parts of this report, U6, the total unemployment rate, rose for the second consecutive month and has risen from 6.5 a year ago to 7.2. Check that, 6.7. It's up 50 basis points. From 6.7 to 7.2, it's up 50 basis points, the U6 total unemployment rate. I've already discussed the part-time for economic reasons. How about the people working 2 full-time jobs for economic reasons? That is at a high that is equated in the past to just before economic downturns. There's stress out there. You can see it. And these numbers were not as strong as the pop media would have you believe. Let's talk about the wage number. 4.5 year over year. That's really strong, Greg. How can you even dispute that? I'm not disputing it. 4.5 on the hourly rate is good. It's great. Hourly wage to me, the minimum wage should be a lot higher than it is. You ask me, but that would be inflationary. But nonetheless, the point is, I'm not disputing that. What I'm telling you is that because there were less hours worked, people worked less hours, their average weekly earnings fell for the month. Fell. Deflation outright for the month because there were so much less hours worked. So who cares if you're making more per hour? Now, it's great in terms of quality of life. It's not great in terms of spending by the consumer and growth in spending, which is needed to pay off all this debt. Doesn't work. Not only that, the rate of change to look at is not 4.5 for earnings. It's the average weekly take-home pay, which fell below 3 year over year, 2.966. So they round it to 3. They say it's 3, but it's below 3%, which means, again, real wages are deflating. Your paycheck's worth less the second you cash it. Savings, gone. Poof. Spent. All right. Thanks to transfers being $4 trillion, you still have, some big. But credit card debt has exploded. What if they cut off credit card debt supply? What if banks get stingy? Well, that's what's happening. We're going to talk about that in a minute. But let's talk about go deeper into the economy. Let's talk deeper in terms of the ISM data. And I love the ISM. The data is great. They're awesome at what they do. The people that are the economists there are highly respected, at least in my office. So, what I'm about to say is no knock on the ISM. The data is what it is. All right, the ISM, you know how they calculate the data. You look at it, you dig deep enough, you'll find the truth. But the headlines don't always tell you the truth. And in the case of the ISM, it's some quirks in the way the data is calculated to create the indexes, where the number reporting the same as last month has a big influence. It's not right, it's not wrong, it is what it is. You look at the data for what it is, and this is what it is. But in the case of the manufacturing sector, the report got everyone all jacked up about how strong the economy was because the new orders index has soared. It actually jumped above 50 just this most recent month to 52.5. It's up from 46.2 in the last 3 months. From deeply negative to a decent positive growth implying number. All right? Big deal by the pop media. This was a big reason interest rates rose on the day this was released. The problem is the way the thing's calculated. At the end of the day, versus 3 months ago, and this month in particular, the percent of firms saying new orders rose was lower than the percent saying new orders fell. New orders falling 23.5% of firms. New orders rising 20%. How's that positive? There's 3% more firms saying the new orders fell in the month. It's a quirk of the way the data is collected. Let's take the service sector ISM, because this was a big deal just this past week. Now, what was interesting is one of the economists, and these guys are really good, by the way, the two. One does the manufacturing, one does the service sector. Service sector, that the optimism in the survey results are due to the potential impact of interest rate cuts. In other words, 100 basis points expected from the Fed this year. What if we don't get it? It could be a bit of an issue, all right? But then also says that firms are cautious due to continued inflation. Well, that's what the Fed's cautious about. Fed said we're going to be careful. We're going to be cautious because inflation could be sustained here. We have to wait and see. Then when we look at the economic activity index, out of the industries, 10 reported growth. 10 service industry firms, or service industries reported growth, against 7 reported contraction. 10 to 7, that's 58%. That's not like robust. It's it's not lopsided. It's barely positive. All right. Now, here's where it really gets interesting. The activity index, the headline index that everyone looks at, 55.8 was unchanged on the month, and 55.8 is a high number, so the economy's good, right? No, not so fast, because frankly, the activity index itself worsened, and yet the index stayed unchanged. The percentage of firms growing went from 25.3 to 20.5. You lost 5%, which is actually 25% of the firms that were growing are no longer growing. How is that a positive? All right. The percent of firms saying that activity that fell went from 18% to 19.8, almost a 2% rise. All right. And over the last 2 months, the number that said the economy is the same or activity is the same went from 62.8 to 59.7. While the percent of firms saying activity worsened, contracted, went from 12.6 to 19.8. That's a 7% increase. And more so, what does this tell you? All these numbers. Let's just simplify it. The percentage of firms saying that that activity is shrinking is bigger than any other category and has drawn flow from both those saying that the activity was the same last month is now saying it's worsened, and those saying activity grew, went right to worsened, didn't even go to the same, didn't stop, don't pass go directly to jail, don't collect $200. So that's really interesting to me, man, because the headline number looks really strong and the innards are exactly the opposite. All right, let's take it another step further, because within the service sector, the price index was expected to fall from 57.4. They were looking for 56.5. Instead, it soared to 64. It's the only index that's above 56. The only index is the price index, and it just soared to 64, the highest in a year and a half. All right. Not only that, in a single month, the percentage of firms saying that inflation is higher rose by 20 full percent. In other words, it went from 15 to 35. And it's 3.5 to 1 in terms of the percentage of firms saying prices are rising. And by industry, 15 industries, higher prices, 1 said lower prices. Let's go deeper because it's really good stuff. Stay with me. It's a lot of numbers, but it's really interesting. The number of commodity, because some of these things don't change like this, man. These are big changes in the most recent month, kicking off the year. The commodities reported up in price in the service industry, the overall service sector of the economy, all industries. The commodities up in price was 6 last month, 17 this month. You added 11. And here's some of the numbers. Here's some of the things you added in terms of rising in price now again. Beef, food, catering, construction contractors, software support, maintenance contracts, power tools, all right, electric components, and office equipment. Think of all the businesses affected by these things, let alone consumers, when you start talking about the pass-through effect of food price increases. All right? And then let's take it one more step further. Because the commodities, which, in the service sector, so I'm not talking hardcore commodities, but the things that are in short supply, in other words, shortages, 3 things last month, now 7, including appliances, vehicles, electronic components, construction contractors. Now think about construction contractors. You need new homes. You have a very low supply of homes. The homes sold that haven't been yet started is good. I mean, home builders are great. This is a good business to be in because you don't have enough supply. And when demand starts to rise, when they do cut rates, you're going to have another big boom in housing and in prices. All right. So having a shortage of construction contractors is only another thing that adds to the inflation and the price increases that we're going to see in housing. So, man, everything means something. But we're talking about the U.S. economy that seems strong, and the Fed is cautious because inflation's kind of lurking. All right, let's compare it to the European economy. Let's talk about inflation in the EU, because this is about being a race between the U.S. and the EU, and it's not about a race between the markets or a race between the central banks. It's about a race between the economies and how quickly it gets the central bank to be easing policy. In this case, the EU. CPI. All right, let's compare the last 17 months. By the way, let's just jump right to where CPI at its peak in October 2022 was 10.6 year over year, 10.6, double digits. From there, it fell 11 of the next 12 months to hit a low just this past December at 2.4. It's 40 basis points from the ECB's target rate of 2. The U.S. would die for that rate right now. 4 months in a row, it's been below 3. But let's look at this another way to look at it. On average, using the monthly report, on average, so 17 months up to October of 2022, all right, just after the peak. The average month was 0.75, which means the annualized rate for that 17 months, every 12-month rate, 9%. 9. The most recent 17 months, the average was 0.11 for an annualized rate of 1.3. So you're actually well below the ECB's target on average over the last 17 months on CPI. And over the last 4, the average is minus 0.18. You're at 3% deflation. So in the last 4 months, minus 3. In the last 17 months, 1.3. The ECB could very easily justify a rate cut here, although there's a lot of reasons that they could say they couldn't justify a rate cut. It's polarized. But when we get to the German economy, obviously the most important in all of Europe, the Consumer Confidence Index just released was expected to show improvement. It didn't. It plummeted. All right. And not only that, but you have 23 months now where it's been negative, below minus 20, actually deeply negative. All right. So from that perspective, when we look at the income expectations went from minus 7 to minus 20. The propensity to buy a big item went from minus 8 to minus 15. It doubled its negativity. The propensity to save doubled to plus 14, the highest since August of 2008. And what goes hand in hand with consumer confidence that's down? Retail sales in Germany have been negative 20 of the last 21 months. The German 2 years are hovering above 240. Whereas the U.S. 2 years at 440. That rate differential is widening, okay? That is bullish for the dollar, and that's a problem, all right? But the Fed doesn't mind that because they want the dollar to ensure that CPI comes back to 2. And right now they don't want to hike rates again. They're afraid that CPI will rise. And even though you have a credit crunch going on, which is why they turned in December, I'm telling you, I told you that already, all right? Their balance sheet's still shrinking at $800 billion on a rolling 52-week basis every single week. All right, M2 remains at minus $453 billion over the last 12 months. Still deeply tight. They're still very tight in terms of kind of monetary conditions. If the dollar rallies, that's really tight, and that would be really bad for stocks. And I don't think the Fed minds taking some air out of the stocks. The Fed doesn't want to be easing, and cutting rates. When gold's at 2,000, the stock market's at record high, and the Nasdaq's through the roof.
In today's fast-paced tech world, finding the right talent is more challenging than ever. That's where EchoGlobal.tech steps in. Whether you're a startup or a large enterprise, EchoGlobal specializes in connecting you with the top-tier remote IT professionals from Eastern Europe. To give you a peace of mind that you're hiring the right professional, they offer 2-week money-back guarantee on top of their 3 months probation period. So, if you're looking to boost your tech team with a minimum risk and drive your projects forward, visit EchoGlobal.tech today and book a free consultation. That's ECHOGlobal.tech. Mention Echo Podcast and get an additional 7% discount.
They might have to anyway, because the consumer might be in danger. Here's the problem. Credit conditions. The senior loan officer survey just told us all types of loans are being tightened in terms of standards, meaning, can you get a loan or not? All right? Especially on consumer loans. Not only going up in cost, not only going up in interest rate, not only going up in the minimum credit score needed, but also in terms of lower credit lines. All right? But the report also shows us there's weaker demand for auto and consumer credit, or credit card loans. Weaker demand. Isn't that interesting? Because if banks are less willing to lend and consumers are less able to borrow, that's a problem. Not only that, but they also said they are seeing deteriorating loan quality across all loan types. We know that. Defaults, delinquencies. All right. Let's look at the banks real quick, because what's happening right now is actually a commercial real estate crisis that we said would happen a couple of months ago. In terms of banks, the loans, the rolling 52-week change in loans is down below $250 billion. Every time that's happened, it's been a recession. Deposits are unchanged for the last 2 years at 17.4 something trillion. 4.5, 4.3, 4.4. It's not moving above 17.5. Right? For 2.5 years, you haven't grown deposits, and you're growing loans at one point $1 trillion annualized. All right. Small banks, they are now borrowing more than their cash level. The only time we ever saw that before was 2006, 2007. All right. The Bank Term Funding Program, which was put in place in March to help banks experiencing liquidity problems, reached a new high of $167 billion. Banks are tapping in. The small banks are having problems. And the problem here is the commercial real estate loan. office space in particular, but all of it. All right, even the malls. I mean, to whatever extent, all of these sectors continue to get hit. You built a lot of warehouses, and you're going to have a delivery and all the things that people were never going to go out and shop again during COVID. Even these sectors are now kind of bloated. All right, the small banks are at issue. They're the ones that are now borrowing more than they have in cash, which is really rare and a sign of trouble. And the ones going to the bank term funding program for liquidity, because they may be in some kind of liquidity crunch. All right, small banks, those below $250 billion in assets, 80% of commercial real estate loans in this country, 80%, 1.7 trillion CRE loans mature in the next 18 months, 80% of which are held by small banks. Small banks with less than 10 billion, really small banks, own a third of those loans. Not only that, it's global. China, Evergrande was the big property developer that got blown up there, right? And what happens there is everyone thought that the government would come in and rescue them. They did allow some delinquencies on the loans, and they didn't have to pay off, and so on and so forth. But eventually, China decided to let it blow up, which shocked a lot of people, particularly U.S. hedge funds who had bought these distressed bonds at like 30 to 40 cents on the dollar. They're trading a penny right now. All right, this is a big deal. Why? Because China's shown they're not going to bail out everybody like the U.S. always does. So this is an issue. You have issues now in terms of Chinese builders in the UK, in South America, and in terms of the U.S. builders, you have these problems around the world because the banks around the world have been involved with the U.S. commercial real estate. The office space right now, we know it's dead. I mean, we just know this, but the numbers are still shocking. The U.S. vacancy rate hit 21% in the third quarter. 1 out of 5 office buildings is empty, is what that tells you. In Asia, it went from 10% in 2019 to 15%. We've gone from 13% in 2019 to 21%. That's more than a 50% increase. All right. So in that case, you're talking about defaults in New York City. I mean, it's going crazy. And you still have 100 million square feet of new building projects planned for offices. All right. Now, PBB, German bank, all right, 4.5 billion euro exposure. All right. This is now, they went from, their bonds are crashing, along with Ariel, who has 9 billion euro in exposure. All right. So these two banks between them, that's a lot, right, for two German banks that are now in big trouble. The stock price in both of these crashing. Okay. The bond price, PBB, is down to 42 cents on the dollar. Ariel is at 76. Ariel's the more in trouble entity, too, if you ask me. That's probably the next target. All right. In terms of the German GfK that did the consumer sentiment index, also does a real estate confidence index. All-time low, German real estate. In Japan, Azora Bank, $540 billion, $500 billion bad loans in U.S. office space. The stock went from 3,300 yen a share to 2,000. Took a 1/3 haircut in basically 2 weeks. I mean, this is affecting everywhere. In the U.S., New York Community Bank. I warned on New York Community all year last year. Their stock broke from 19 to where it's been hanging out to 15, and now it's at 4. And this is why the Fed went dovish in December, I'm telling you. All right. And now the banks, they're going to tighten the standards on consumers, on credit cards in particular. This is where the credit crunch comes. And the numbers we literally just got from the Fed on the most recent consumer credit numbers are horrible. 1.5 billion, which is a tiny number. All right. It's the third out of the last 8 months to be negative or basically zero, which 1.5 billion is basically zero, believe it or not. It's hard to say that, but it's true. But here's perspective. All right. Since May of this year, so the final 8 months of this year, consumer credit, 51 billion. The same 8-month period in 2022 to 2023, I got to check that. In 2022, I should say, was 229 billion. You're a 77% decline in consumer credit growth over the last 8 months compared to the same 8-month period a year ago. All right. The numbers annualized on the month here, 0.4 on total credit growth, down from 5.7. Revolving credit, which is credit cards, 16.6 down to 1%. I mean, and here's the most interesting stat of all. Out of all these new loans that are made, credit unions have been one of the largest contributor to those loans. And that's a sign of stress. I've only seen this now where commercial banks are scaling back Their loans are dropping, whereas credit unions' loan growth is going through the roof. That's a sign of stress. They're a lender of last resort. They're a borrower, where a borrower would be more desperate, can't get a loan from the bank, goes to a credit union. They're going to be a little more lenient. When's the last time we saw this? I saw this and called this and talked about this in 2007. 2007. So when you talk about the consumer credit, the rolling year-over-year rate of change is now 2.4. Now, that's low, all right, because you've only been below 3% on 3 other occasions in the 50-year history of credit cards. 1991, 2009, and 2020. Biggest recession that we had outside of a crisis, 1990. 2009, obviously the financial crisis. 2020, the pandemic. And now. And all of this gets you the S&P 500, which is at its peak, had a 3-month rate of return of 19%. 19%. It's the second largest in the last 10 years. You got to go back outside the pandemic. You got to go back to March of 2019 to see a 3-month rate of return that's 20%. On the back of this, what I just told you. All right. So where do you go? Well, we do the portfolio playbook, which is kind of a quantitative, technical, really strategy, macro, in terms of allocating differently than some of these other people do. You really want to be diversified, totally. And in this case, we do some of the quant work for, some of the institutions that we have as clients where they're allocating it to sectors. All right. Right now, the financial sector is the hottest sector. Infotech's actually dropped to number 2. Consumer discretionary's jumped to number 3, and healthcare is in there at 4th. All right. The problem is, for the financials, it's not the banks outside of JP Morgan who's going to eat up all these little banks and be the shark waiting to, get bigger on the, on the blood of others. But the dynamic around the financials, it's been all about the insurance companies. The KIE, the insurance sector, has led the way. All these Aflac, Progressive, they've all been at new record highs. And now they're coming off. There's some concern about them in commercial real estate too, with some insurance contracts that are out there. All right. Doesn't that sound familiar? 2008. Holy mackerel. All right. The banks know. It's the brokers and the markets themselves that are providing the impetus for the financials to rise to number 1. Stocks like the NASDAQ stock. All right. The Blackstone, S&P Global, CBOE, the MSCI, which does all these indexes. They're all the XBD broker dealer index is about to make a new all-time high. It's the market itself that's driving the financials, not the banks. Don't trust the banks. Don't trust the financials because it's tied to the market. So you want to be in the market and have a double alpha by being long the market in the market. Well, there you go. Now how about the consumer discretionary? Well, it's being driven by a couple of shares, Marriott, Hilton. It's hotels, it's travel, it's tourism. But then you look at 2 stocks in particular that are way up on the quantitative rankings, the big bullish trends that are very robust. AutoZone and Chipotle. They're $2,800 per share stocks. Chipotle deserves it on the back of a 37%, year of earnings growth. The revenue is up 15% to $2.5 billion in the fourth quarter. Same store sales up 8.5%. But they opened 121 new stores. They're going to open 315 new stores. Have we not seen this in retail before? All right. So it's the growth dynamic here that has these stocks. AutoZone, correct me if I'm wrong, but this is an auto parts place that trades at $2,900 a share. That seems to me to be an issue when you talk about, and I'm not saying it doesn't deserve to be there or anything. I'm saying, where's the growth? Mathematically, the growth has to be so big, it's not even funny. It really isn't. It's kind of insane. It's a mathematical conundrum. Now, here's the NASDAQ, all right? Because I like, what I own. The XLK is part of our portfolio. Infotech, you have to have it. Okay, you have to. But when we talk about the geometry, because I do everything in the geometry using Gann angles per se, you can give an upside target for the NASDAQ of 22,500, and that fits with the recent measured count based on the range you've seen over the last 2 to 3 years. So you could say that there's still a lot of upside in the stock market. And certainly on the back of AI, well, that's great. It's new technology is going to change the world, but you need to sell, you need to package it. You need to figure out a product that can be used. You need to package it. You need to sell it. You need to find a way that consumers can actually pay for it. So I don't know. That's a longer game, right? So in that context, we're still like healthcare. I like the pharma. I like the biotech right now. It's been really depressed. We like the home builders. We love uranium. That is, outperform natural gas and crude oil. But I also like energy. Also like the food commodities. So you can come check us out on any of that. But what I really like here, and what we really pushed for our clients recently, crypto, Bitcoin and Ether, both. All right. To the extent that, Bitcoin's going to 70 easy and probably higher, going to make new highs, I think. It's the ultimate anti-dollar play. When the dollar will hurt all these other commodities, including gold. I mean, Ether is breaking out against the S&P 500 and against gold. That's big to me. I mean, and when you look at the dynamic around the dollar and you look at how global this is, where you can't just run out to the bullion dealer and buy gold or do some of these other things. Everyone has a phone. Everyone can get an app, and almost anyone can kind of buy Bitcoin. It's not tied to another currency. This is where it really does become what it's supposed to be, which is the anti-dollar play at a time when the dollar's appreciating potentially and knocking stocks down, knocking commodities down, because that's what the Fed wants, even in terms of risking a credit crunch that becomes really problematic. And then the Fed's like, oh my God, look what we asked for. We got it. And then they're really screwed. And then they got to print all kinds of money. And that's when gold explodes too. But Bitcoin will already be higher. So we still like gold as well. Anyway, you can get more information on the work we do. We actually have what we call the Gold Guru product right now, which is crypto as well. We're all over this move in Bitcoin, all over this move in Ethereum, all over this move in uranium. It's about the metals and foreign exchange, which includes crypto. And it's a good product. It's reasonably inexpensive. And, our clients absolutely love it. And it's a product that is basically designed to make you money. So that's our goal here. And just to say thanks for listening, signing off until our next episode of Money, Markets, and New Age Investing. Follow me on Twitter at Weldon Live. Follow the podcast at Money_podcast on Twitter.